Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod, where does the true cost of inflation go?
Wall Street has not reacted badly to the tariffs yet.
And the question is, should they?
We go behind the numbers with economics reporter Steve Liesman.
At least in the data, we cannot find the idea that foreign exporters are absorbing this price, at least not now.
The latest data suggesting that companies are still bearing the brunt of tariff uncertainty. When does it hit consumers? We talk exclusively to Chicago Federal Reserve Bank President Austan Goolsbee, who is sounding a note of caution.
Let's not overreact to 1 month of CPI or PPI inflation, but it's at least an area of concern.
Plus, the surprising news that the U.S. government is considering taking an ownership stake in Intel days after President Trump wanted the CEO fired. Our Eamon Javers reports.
We don't know exactly what happened in that meeting, but something happened to turn the president's mind around in a big way on Lip-Bu-Tan and Intel.
But can Uncle Sam really pick winners and losers?
We have been trying, maybe you could argue unsuccessfully, but I think relatively successfully over the last 100 years, to export our brand of free market capitalism to other countries. We have long denounced national champions. When other countries have taken these golden shares and golden stakes, we've said that's a bad idea.
It's not going to open up the floodgates. I had a lighter on my head and I kept going, and I couldn't get it going.
It is Friday, August 15th, 2025. Squawk Pod begins right now.
Stand Andrew by in 3, 2, 1. Cue Andrew.
Good morning. Welcome to Squawk Box right here on CNBC. We're live at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin along with Joe Kernen. Becky is off on this summer Friday. Take a look at U.S. equity futures at this.
First up today on the podcast, U.S. stock markets on track for a winning week in spite of a stumble Thursday.
We'll have a mixed day. It's been quite a ride, even though we're not going to finish on either side of flat.
Most stocks down, but the market managed to hang in there.
When a hotter than expected producer price index saw wholesale prices had risen in July, a 0.9% jump that was the biggest since March of 2022. Now, this could indicate that sticky inflation remains. Companies have been bearing the cost of potential tariffs or the actual levies themselves and not passing that on to consumers. Yet, is that about to change?
You know, the Journal has a great, they make me think about a lot of things, and I'll tell you what I'm thinking. So the Journal's right. We now know who's paying for tariffs. CPI, companies are eating a lot of them so far. They're eating a lot, but they can't do that forever.
Correct,
probably.
And that's why it's going to ultimately get to the customer.
Eventually it hits the consumer. The scary thing, and the Journal points it out, is that the worst thing about inflation or even one-time cost increases is that it's hard to have real wages increase.
Correct.
And it's been anemic now. 0.1% in July, 0 in June, the 0.4 in May and March might have been.
But that's how they eat it. That's one of the ways they eat it.
That's the way they eat it,
and that's one of the way we eat it.
But the reason that people felt crappy during the Biden administration when everything seemed, stock market was at highs, things seemed like they were going well, their purchasing power didn't go up. Their real wages were down, and we mentioned that again and again and again. They finally turned up towards the end of the administration, but by the end of the administration, you still were making less in weekly real wages than you were at the beginning of the administration. So it's an issue. But what bugged me about this, Andrew, was that perhaps this is one reason Wall Street reacted badly to the producer price news. The S&P was up to a new high, 2 points yesterday. The Dow finished down 11. The yield curve at this point, remember those numbers? We were worried about 4.5 on the 10-year. We were worried about 5, I think, on the 30-year, and we were worried about. There were all those round. We're still well below all those levels. We're at 429 on the 10-year. Well, I'm just saying Wall Street has not reacted badly to the tariffs yet. We're at new highs. The bond market is not ready.
Correct. And the question is, should they?
Still could.
That is the question.
We always say that, and I always feel uncomfortable thinking that the market doesn't know what it's doing. I think at first.
I think we've been in a number of situations, you and I, over the years, where the market has been not correct.
I think there's been many more times where you thought it shouldn't be doing what it's doing, and it continued to do it, and you finally just threw in the towel. I think that's happened.
I think there's a couple of those times. I don't disagree.
I think that's
there's a couple of those times.
I just defer to Mr. Market most of the time. You know what? Mr. Market doesn't like August, and it doesn't like September. So there's certainly
It historically doesn't like October either.
Because we bottom in October. We go August and September, and then we have the horrible day where there's there's been a lot of bottoms made in October. Our top story this morning, and then we'll get to the intel, because I'm having trouble getting all agitated about this. I don't know whether you are, but President Trump is set to meet Russian President Vladimir Putin later today in Alaska. It's going to be Putin's first visit to a Western country since he and his country invaded Ukraine in 2022. It's his first trip to the U.S. in a decade. The two leaders will discuss the Ukraine war at a military base in Anchorage. It's expected to be a one-on-one gathering with the Kremlin saying interpreters will also be present, which would be necessary. I think it's a good thing. You're going to get nowhere if there's no interpreter. If Putin's speaking Russian and
without the interpreter.
And Trump speaking it, you get nowhere, right? I think it's a great idea.
I would just bring Gemini with me.
A joint, really? You picked Gemini this time. You
translation.
Said oh, really?
Fantastic.
Really?
Real-time translation.
So there's like 6 of them.
You got to pick your poison for the specific.
I said the other day.
You can't really say pick your poison in this kind of conversation.
My favorite name is Llama, because I just like to say Llama, but I don't know which one's best. You do. A joint press conference may be on the agenda. It's unclear, though. Either way, President Trump said he's going to talk to the press after meeting Putin. President Trump says more important than the sit-down with Putin would be another meeting, which also includes Ukraine's president, Vladimir Zelensky. The president suggested that could happen before he leaves Alaska, but Russia has not agreed to that yet. Trump has warned very severe consequences, in his words, if Putin does not agree to end the war or get some type of ceasefire, or at least to start planning an end, though he has publicly downplayed the chances of an immediate ceasefire.
Let's talk about this corporate news. I know you have views on it. We'll bat it around in a moment. I want to get to Eamon Javers first, and then we'll talk about it.
I'm sure Eamon's agitated, but I'm not.
Hold on. The Trump administration reportedly considering taking a stake in Intel. Shares of the chip giant jumping on that news. Eamon's in Washington right now. That's Eamon Javers, of course, the one and only. And we want to get his take and maybe some of the details about where things stand, and then we can all bat it around together. Go for it.
Yeah, Bloomberg first reported this news, Andrew, and now the Wall Street Journal's got it too, which is that according to those outlets, the White House is considering taking an ownership stake in Intel in exchange for an investment. The size of that investment, we don't quite have that information, and we don't have the information of how much of a stake they will take. But here's the statement from the White House. They say discussion about hypothetical deals should be regarded as speculation, they say, unless officially announced by the administration. So the White House downplaying this, but you'll note that's a no comment, Andrew. It is not a denial, and certainly doesn't say that would be an inappropriate thing to do. For its part, Intel also out with a statement. Intel's statement similarly also talks about speculation. They say Intel is deeply committed to supporting President Trump's efforts to strengthen U.S. technology and manufacturing leadership. We look forward to continuing to work with the Trump administration to advance these shared priorities, but we are not going to comment on rumors and speculation. So no comments around the horn from the key players here. We know that the CEO of Intel met with President Trump on Monday at the White House. The president had been calling for his ouster before that, said he was hopelessly conflicted because of his business ties in China. Lip-Bhutan meets with the president on Monday one-on-one. After that meeting, the president posts on social media and says, actually, he's got a fascinating story. He's got some clever ideas, and we're going to be working together to develop those ideas in the coming weeks. So we don't know exactly what happened in that meeting, Andrew, but something happened to turn the president's mind around in a big way on Lip-Bhutan and Intel. And now we have this reporting from Bloomberg and the Wall Street Journal saying that part of what that might be is this idea of the U.S. government taking a stake in the company.
And the question that I have about taking the stake in the company is, what is the U.S. government going to be? Well, I have about 100 questions about the implications of it, but
right.
The idea that we are taking a stake, what does that actually mean? What kind of taxpayer money are we giving to Intel? Is Intel giving a stake in Intel to the taxpayer as a present?
We're already giving them a lot of taxpayer.
You know that. Of course I do.
The reporting from Bloomberg,
what exactly are we talking about
from
here?
Bloomberg is, I mean, again, we can't match this as of right now, but what Bloomberg has reported is that this would be a U.S. government investment of dollars in exchange for a stake. Now, presumably that's an equity stake. Presumably that's shares. We don't know for sure how it would be structured. And we don't know how much money. The idea being that this would kickstart investment in plants in the U.S. to build chips. That's the president's goal here. But as you say, Andrew, this is a company that's gotten a lot of money from the U.S. government in the Biden administration.
And
there was a ton of money for chip development.
So, Eamon, let's talk about this, though.
And the question is, what's the difference this time around, right?
The companies in America where the taxpayer, the government, has taken actual stakes in businesses, I think I can count them for the most part on one hand. Obviously, there were the banks post-2008 crisis for a period of time. But with the plan being and the proviso being that they would be out, and they were within, in this case, they were within about a year.
Automakers, we made money.
Fannie
and Freddie.
We had General Motors, and we had
Motors, Fannie and Freddie. Yep.
Fannie and Freddie.
We had Fannie and Freddie, which we still own.
Right.
Anybody else?
Which is a whole other issue. Off the top of my head, I can't think of any. And in each of those cases, the situation was viewed as existential, right? These companies were going to fail, and to borrow a term from your book, they were too big to fail, and the U.S. government couldn't allow that to happen, and so stepped in and made a massive taxpayer investment, and that has, for the large part, worked out. With the exception of Fannie and Freddie, which the U.S. government doesn't seem to be able to figure out how to IPO. There's some speculation that IPO might be coming under Trump 2 now. But the idea is that these companies are in an existential, dire crisis, and the U.S. government has no other recourse other than to do this.
Well, now it's
for
that
both
our
parties. The approach has been, we won't do this unless we absolutely have to, because we don't want government
now it's a
meddling
security
in the private
thing.
sector.
Now it's not for Intel. It's for we want those the strategic metals. So we're doing it with that company. This is about China, and it's about an existential threat, not to the companies, but to our ability to compete in very important security issues in the future against China. I didn't realize that they almost did it. William Barr wanted to do it with telecom companies to compete with Huawei in the first Trump administration, but it never went forward. So it's been considered before. I mean, it appeals to me a little bit more than just grants. If you take care of child care, we'll give you a bunch of money at Intel, and we get nothing for it. Here's the other thing, and you wonder about, are people scared? Are CEOs afraid to push back? I think at this point, it's like, it's fighting City Hall. It's like, if you can't beat them, join it. This president is going to do these things. And I think you almost get inured to it at some point. And you don't know whether this is going to be a good thing or a successful thing or not at this point. They give him the benefit of the doubt because they can't stop him. He's president.
Well,
yeah, two other examples just from this year, guys.
That's
as you
a low bar.
This. One is this golden share with U.S. Steel.
Right.
The golden share with U.S. Steel and the 15% deal with NVIDIA and AMD, right?
So let's just talk about all
getting
these
a revenue stream from those companies.
And here's the distinction in those cases and this new Intel deal, which is these are effectively long-term investments, which is a very different approach, right? The others were rescues, right? And by the way, they were rescues with the proviso that at least the stated plan, even with Fannie and Freddie back in the day, was actually that the government was going to be in and they were going to be out. The plan wasn't, we're in and we're here forever. I would imagine this investment with Intel, as it appears with some of these other arrangements, is a much longer-term arrangement. That probably has implications, by the way, for the entire industry, Joe. So I don't know where you sit there. The other piece of this, though, that to me is the longer-term thing, and I know you may think, first of all, this CEO it appears is doing this under duress because he might be losing his job otherwise. Maybe. So let's just put that to the table.
That Intel is
it's a mess.
It's somewhat an existential thing. And you've mentioned
maybe
they build the foundries, and you've said, well, it's important. They're the one company that does have the foundries. So
maybe
you would want them to.
You might. What I don't know is whether there's a long-term, decades-long implication for how other countries are going to do business or not do business with the United States in the future. We have been trying, maybe you could argue unsuccessfully, but I think relatively successfully over the last 100 years, to export our brand of free market capitalism to other countries. We have long denounced national champions. When other countries have taken these golden shares and golden stakes, we've said that's a bad idea. And we have tried so desperately to create a system in
Andrew,
the world.
It's not going to open up the floodgates. I tried, and I had a lighter on my head, and I kept going, and I couldn't get it going. I could not get it going.
I know.
Yours is so tender, it's so dry and so ready that a spark from lightning in yours is, I can't get agitated. Are you agitated about this?
I'm not agitated.
But you're pointing out all the downsides when...
That's the job. The job is to say there's upsides. Let's talk about the upsides and let's talk about the downsides. Why are we not allowed to talk about both of these things?
But I just, all of a sudden...
Because instinctively you only talk about what you think of as everything is good, everything is great.
Eamon, all of a sudden...
By the way, in the last administration, if Biden had done this, your hair would have been, there would have been an explosion.
It's consistent. It was. It wasn't fine. This isn't the same thing, though. This isn't this isn't giving it away if you have union workers and child care and DEI. You hire enough.
Eamon Javers, break in here and tell us what you think.
Eamon's fine. Look, he looks fine.
Look, I mean, it's not my job to think one thing or another, but you got to put it in context, right? And this is... Joe, this is getting closer to sort of state champions and state-sponsored capitalism
if it's a slippery
in a way
slope,
that we haven't seen in this country before. And so you debate whether that's a good idea or not.
Right. We can't.
Look, I talked to folks in the White House earlier this week about whether the idea of NVIDIA 15% stake was a one-off.
It's an export tax.
And the initial reporting I got from the White House was, this is a one-off. It's artificial intelligence. It's chips. We're not envisioning doing this in a more broad way. Right. 2 days later, we had the Secretary of the Treasury come out and say, actually, you know what? We view this as a model, and we think, this could work in other industries and other cases. Right. So, these things have a way of taking a life of their own, and once people see the revenue coming in, it's hard to let go of that.
You could, right now it's the strategic metals, it's steel, it's chips, it's NVIDIA.
By the way, I'm not saying that this is, the end of the world. I just want to be clear.
I just don't think it's a slippery slope. I don't think all of a sudden you can extrapolate that that the government's going to have a stake in every, in tapestry to make decent
for the
bags.
last 15 years I've known you, everything's a slippery slope. If we go this way, it's a slippery slope.
You got to deal with it. I mean, I told you, I'm getting inured to it. These are out-of-the-box ways to think about things. And I'm not immediately going to say that the world is ending because we're turning into China, state-sponsored industrial.
But we are turning into China.
Well, we were well on our way in a much worse way from before when I didn't hear a peep out of you. So
okay, Eamon Javers, thank you for waking us up this Friday morning. Summer Fridays here.
Look,
we appreciate it.
He's got more hair today. He's got more hair. I don't see any of that. It smells when it burns, and it's horrible. Terrible.
He looks good. He looks handsome.
Yeah. He does.
Cheese will be next.
Coming up next on Squawk Pod, like the central bank, we love a data dump, the numbers that tell us what could be going on in the economy. And we're bringing a decision maker into this conversation, Chicago Fed President Austan Goolsbee.
We put in a note of unease, I'd say, in the last CPI and now PPI, with the inflation kicking up in categories that are not obviously going to be transitory.
What the numbers signal for the next Fed decision in late September, and what they could tell us about America's inflation picture. CNBC's Rick Santelli is keeping an eye on investors.
The most interesting feature about them, CPI and PPI, is the market response.
Back after this. This is Squawk Pod.
Up and Andrew, Q.
You're watching Squawk Box on CNBC. I'm Andrew Sorkin along with Joe Kernen. Look how you just sort of gave a little look to the camera. See, look.
Did I?
Yeah, right there. I saw that. There.
Yeah. Is that come hither? I don't do that.
I don't know what that look was.
That's never worked for me my entire life.
I'm not sure what you're doing there.
Retail sales, usually important, but import Imports. Steve's very excited. Rick Santelli standing by at the CME in Chicago. Could anything change? Could we have a whole new view on everything based on imports today, Rick? Probably not, right?
No, it's hard to tell. These numbers the last couple of days, the most interesting feature about them, CPI and PPI, is the market response. We could spend a lot of time digging into data and looking at how strange some of it is, but the market divined it real well. Here we go. It's hitting the wires. Retail sales, this is for the month of July. It's the advance. It's going to change in a couple weeks. Headline number expected up 0.6, comes in darn close, up 0.5%. Up 0.5% compares pretty good with the up 0.6 in the rearview mirror, which hasn't been revised yet. And the up 0.6 was the second best number of the year. 1.5 is the high water mark in March of this year. If we strip out autos, it actually still retains a good chunk of that growth. Up 0.3, and that's exactly as expected. It follows up 0.5. Don't see revisions yet. Ex autos and gas, it holds up okay. It's losing a little bit of steam, up 0.2. Now 0.2 ex autos and gas, that would be the lightest since it was unchanged in May. So not bad numbers. Revisions starting to come in. I'll get to those momentarily. The core retail sales or control group coming in at nice 0.5%, better than expected. 0.5% is what the rearview mirror was, but we'll get to revisions in a second. Here we go on the revisions. So the numbers are pretty good with respect to the advanced July. Look at the rearview mirror. Headline now moves from 0.6 to 0.9. Ex autos from 0.5% to up 0.8. Ex autos and gas from up 0.6 to up 0.8. And that control number moves all the way up to 0.8 from up 0.5%. These are solid growth numbers. Now let's go to import prices, shall we? Import prices, these are all July. If we look at the headline number, up 0.4. Okay, Joe, that's definitely warmer than expected. Up 0.4. Well, that would be the high water mark of the year. That would be the high water mark going all the way back to tax time of 2024, April of 2024. So we see import prices under a bit of pressure. If we strip out petroleum, they're still on the high side, up 0.3. Up 0.3 equals the high water mark of the year in April. And you're going back to April of last year to find a higher level at up 0.6. Now, if we take a year-over-year perspective, those were month-over-month. Year-over-year perspective on import prices, down 0.2, which means 1, 2, 3. This is the third down 0.2 in a row. Okay, switch gears to export prices. Export prices up 0.1 on a month-over-month headline. On a year-over-year, they are up 2.2 year-over-year, up 2.2. Where does that comp? Well, May was 1.9. Last month was 2.6. Fits right in there. We are seeing some revisions on some of these import-export prices. They're going negative. So we see minus 0.1 now on import price month over month. That was originally up 0.1. We have one category left, folks. Empire Manufacturing comes in powerful. 11.9, we're expecting unchanged. 11.9 would be the second highest of the year outside of March when it was 20. The market divines all this better than any single human can. Interest rates have moved up a bit. We were at 4.29 and a 10. Now we're at 4.30. How does 4.30 compare? 4.30's up 2 on the session. It's up 3 on the week. And we want to pay very close attention to what's going on in the pre-opening equities. They haven't been phased much. Still a powerful opening expected in the Dow Jones Industrial Average. Joe and the gang, back to you.
All right. Very good, Rick. Seemed a little continued upward movement in the 10 years. Steve Liesman joins us now with more. Did
Rick take a breath when he did that?
No, he doesn't do that. Did this live up to your expectations?
I'm excited by this. I think the retail numbers are good. That's the most important thing to me, but I don't know how much of this is going to be inflation, how much you have sort of tariff inflation in here. What is interesting is to see that this number may be help GDP forecast. We came in with the Atlanta Fed tracking at 2.5. CNBC Fed survey at 1.25. That's the forecast versus the tracking. Bit of a boost in gasoline station sales. And the key about this big question, who's paying the tariffs? If import prices are up, it means that they're not paying it overseas. And I would look at one particular category. I just want to find it again. Finished goods. Prices for major finished good import categories were mostly up in July. Import prices for consumer goods increased 0.4% in July. So at least in the data, we cannot find the idea that foreign exporters are absorbing this price, at least not now. And maybe actually they have somehow used this opportunity to increase prices a little more. Forget my analysis. Let's get some real expert analysis. Joining us now, Chicago Fed President Austan Goolsbee. Austan, thanks for joining us this morning. We have
good morning, Steve. How are you?
We've now had 3 of the 4 inflation reports we get in this nation. The most important come in the end of this month, PCE, but we can kind of calculate that. Take a step back. We know you don't react to any single inflation report or any single report. Give us your picture right now, or your sense right now, Austan, of the inflation story in this country right now.
Well, it's been a little mixed. It feels like the first 2 of the 4 came in quite mild, and we were feeling good. And I was saying here and elsewhere, if we get several reports like that, I'm going to feel comfortable that we're still on the golden path and things be okay for rates to come down. We put in a note of unease, I'd say, in the last CPI and now PPI, with the inflation kicking up in categories that are not obviously going to be transitory, which is to say the services inflation look to be turning up. So I feel like we still need another one at least to figure out if we're still on the golden path.
Were you looking, as I was this morning, into those import prices to see if they were the exporters were absorbing some of this, and now you don't see it? What is your sense of this number this morning? Usually, I don't know, in 23 years of doing this on TV, I've maybe talked about import prices 1 or 2 times before, but now it's kind of important, right?
Yeah, look, we're out sniffing in all sorts of places that are not normal to have to sniff. The thing about import prices to remember is they don't include the tariffs. In most of those cases, the tariffs will be on top of it. So if the foreign is absorbing, if the foreign exporters to the United States are absorbing the cost, those prices should be going down. If those prices go up and then you add the tariffs on top of it, that's a little bit the scenario, that's the unease scenario where, the costs are going up and now we're in the business of trying to figure out, well, how long are those price increases going to last? Let's not overreact to 1 month of import price data, for sure. Let's not overreact to 1 month of CPI or PPI inflation, but it's at least an area of concern.
Austan, when it's come to rates, you've been maybe, what do they say? St. Augustine said, "Oh, Lord, let me be chaste, but not today." Your attitude has been...
I thought you were going to say brilliant and prudent, Steve. What
Yes,
is this?
Yes, sir, and chaste. But the thing is that you've talked about rates will come down over time, but you've been a little bit circumspect about the time over which they should come down. Could you give us your sense of that right now?
Well, I was pretty specific of the time frame in the run-up to April 2nd, and that I thought over the year they could come down a lot because we're at pretty much full employment and inflation was headed to 2%, and that's the thing that the FOMC by law is supposed to be looking at. What's happened is we've added a lot of uncertainty and we've added a lot of dirt in the air, which much of it has come from tariffs. And the tariffs, the theory that tariffs are a one-time price increase, that's true for one and done tariffs. And these haven't been one or done. And so we're trying to grapple with this idea of, is this going to be a persistent inflation shock? Is this going to be stagflationary in direction, which is to say it's going to be driving down employment at the same time as driving up prices? That's the worst thing the central bank has to think through because there's not an obvious playbook. You got to sort of weigh off which of these is a bigger miss and how long is the bigger miss going to last. So you can't answer the question, when will we know that we're back or still on the path that we were on before April 2nd, without answering the question, is this going to be the end of the stagflationary shocks, or are we going to keep getting new policy administrations?
So when you say that and you talk about this, it sounds like you need some time at the least. And if you could, when you respond to that, also answer this question: how much does the Fed's stance about policy play a role in figuring out whether or not tariffs become a wider spread problem?
Okay, you know the rules. I'm not allowed to speak for the Fed or anybody else
Sure.
on the command. I can just talk about how I think about that. I think partly the conventional wisdom for how should a central bank respond to a stagflationary shock, which I think of tariffs as having a heavy stagflationary component. The primary effect, the Fed can't pump oil, the Fed can't adjust the supply side, but it can try to prevent the secondary impacts, which could be wage price spirals, or if you start thinking about the secondary impacts of tariffs on parts, components, supplies, and intermediate goods, now it's a little more complicated than the Econ 101 version, because now the tariff isn't just staying in its lane, it's going to be raising the cost of production for domestic manufacturing and others. And that's a lot of times, certainly during COVID and post-COVID, took time to wind its way through the economy. So I do think we're going to be in the business of trying to figure out which part of these price increases are we ignoring because we think they're transitory, and which ones are we responding to. Now, that doesn't mean that we have to hold forever or for as long as it takes for the prices to come back down. It all depends on the data and what's the economic outlook. If we keep getting inflation reports like the ones we had, the first two of these four that you mentioned, I would be very comfortable that, hey, the dust is out of the air. It looks like we're still where we were, which is a strong economy with inflation coming back down. In that circumstance, I think it's totally fine. It's expected. It's the right thing to do to bring the rates down to where we think they're going to settle. You know, we got to get some clarity from the numbers.
One thing we all hope for, no matter who we are, is that real wages go up, or weekly real wages keep going up. I mean, what else? Why else are we doing anything in this country, Austin? And, right. And it's been pointed out. Yeah. You know, the Biden administration had a problem for the first two or 3 years because of the inflation rate, and that was constantly harped on by critics that real wages, weekly wages, haven't grown. Now they're kind of stagnant again. And what you just described, I would imagine if the labor market weakens, you're not going to see people asking for more money, and if inflation comes back, then we could be stuck in the muck again, and that spells doom for current administrations when people feel like they have less buying power than when they started.
There's two parts to that. The political part, I joined the sworn member of Federal Reserve. I'm out of that part of the business, but you're an expert on it, Joe. I don't know what it means doom. I do know that's a mess. That's the mess of something moving in a stagflationary direction. Is no one's happy, and they shouldn't be happy. Prices going up, wages going up less than prices, incomes falling, but not getting any relief on the inflation side. That's what we want to avoid. We're going to have to see where we are. I still think underneath all of this, we were in a strong position on the economy going into April, and there are still a lot of strengths in the economy. So if we can assure ourselves or get a hint that for this meeting or the meetings this fall that we aren't on an inflationary spiral that looks to be persistent, I still think it makes sense, given the strength of the economy, to move rates more back to where we think they're going to settle.
Austin, I want to be clear about what you were saying. I want to make sure you finished the thought. You said if we get inflation reports like we got earlier, and by earlier, I think you meant before the ones this week, then you'd be fine to let through. But the ones this week, I just want to be clear, are they giving you pause about reducing rates?
they're in the space. I don't like tying my hands before a meeting, especially at the hardest thing the central bank has to do, as I always say, is get the timing right at moments of transition. So I want to get all the data we can, and I want to hear from my colleagues. It seems like people have some different views about what's happening. But the fact that services inflation for the single month was coming in at a rate we haven't seen in a long time, very high services inflation in that new data, that makes me a little uneasy because that's very unlikely to be caused by tariffs. So I'm hoping that was a blip. If that wasn't a blip, then that's an area of concern, and we're gonna have to grapple with that.
Austan, I want to have a quick conversation, like we used to have when you were just a professor, and we'd meet at the American Economic Association annual conference.
That's
because
right.
one thing we don't talk about is what's happening on the employment side of the mandate. And you've started to talk about this, and some of your colleagues have as well, which is where's the break even anymore? Given what's happening in immigration and with deportations and what's happening with the labor force, we used to say, 100,000 is break even for the unemployment rate.
Right.
But now, if we did 50, would that cause you alarm as a Fed president that the employment market is weakening? Or do we need to move, I guess my question is, from thinking about the levels of employment to thinking about ratios of employment because of all the changes happening on the labor force side?
Look, I think a little bit, yes. As I say, I just try to be a data dog, and one of the main rules of the data dogs is don't be too choosy about what you sniff. Whatever hits the floor. And we had a moment, we've had long moments where the headline jobs created number is the tentpole number that everybody wants to look at as an indicator of where we are in the business cycle. We saw in 23 and 24, when you have uncertainties about population growth, especially coming from immigration, but where you have those kind of uncertainties, you can get way off from where you think the break even is. And we had that in 24. We're coming in 150, 170, 190,000 a month. And we thought the break even was 85,000 at Chicago Fed. But that wasn't a sign that the economy was overheating. It was a sign that we were getting the population growth rate wrong. If we're in that environment now and immigration is going down, let's just be careful about over-indexing on that monthly payroll. And my intuition is exactly what you said. Those ratios and rates were a little bit better indicator of business cycle. So the hiring rate, the layoff rate, the job openings rate, and the unemployment rate. Those are kind of the four horsemen of justice in this thing.
And harkening back to something we talked about earlier on the show, Austan, could you ever foresee a Fed chairman with hair like Axl Rose, with like a David Zervos type ponytail? Is that in the realm of possibility? Is that in the realm of possibility? And not just because
I don't know. You think they need to be bald? What is your position?
I like bald as opposed to.
You like bald?
Yeah.
I had a minute left for a question.
I'm not an anti-baldite.
I heard that there used to be in the Fed building. There used to be a barber. Yeah.
No, if he cuts it now, then he really wants it, right, Zervos? If he comes on. Yeah, if he suddenly comes on and he's high and tight, like
shave the beard too.
Austan, thank you very much. Appreciate it.
Yeah, great to see you guys.
Please come again. It's a pleasure and a privilege to have you come on from time to time.
Thank you, Mr. President.
And walk us through these difficult times.
Mr. President. Happy birthday, Mr. President. No, it's not.
Thank you, Austan.
We'll be right back. And we're back in the office a couple of days a week. Here's Andrew.
Welcome back to Squawk Box this morning. Microsoft getting ready to implement a post-pandemic return to office policy with guidance possible in the next few weeks. That's according to a new report from The Verge, which says starting in January, so we're talking January of 2026, Microsoft will call any employee who works within 50 miles of the company's Redmond, Washington campus into the office. You ready for this? Drum roll, folks. 3 days a week. That's the deal. 3 days a week. The report says that some employees will have to come back 5 days a week, but exceptions will be considered. Microsoft relatively late to the game, relatively late to the return to the office push. Amazon and Google have already instituted back-to-work policies. So we will see what's going on in Redmond, Washington. And Joe, I should say, while I'm talking to you, the reader, the viewer.
What did you say, though? You said,
there's a fly that's going around the studio. Boom! And you missed it. And the whole time.
Because I couldn't do it while.
The whole time I'm speaking, you have this newspaper up as you're about to hit the fly.
I didn't want to do it because it would have been disruptive for you.
To be speaking to the audience.
Right. It would have been disruptive.
And this wasn't disruptive.
I'll get him next time. Coming up, I'm afraid to do that because there will be someone out there, some bug-friendly person that thinks there should be a way to capture the fly and release it. There will be, I guarantee you. The only thing, you can't say dead cat bounce. You got to say dead rock bounce. You can't even say dead roach bounce because there are roach fans. Not that kind.
That is Squawk Pod for today and for the week. It's Friday, finally. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Tune in weekday mornings on CNBC at 6 Eastern. Get the best of our TV show right into your ears when you follow Squawk Pod, wherever you get your podcasts. We'll meet you right back here on Monday. Have a good weekend.
We are clear. Thanks, guys.